Cathie Wood, infamously, her fund's performance took a nosedive in 2022, falling nearly 70% in the period between November and June. But recent developments have seen the ARK Innovation Fund begin a massive comeback, with the flagship ETF up 40% from its recent lows. In her most recent video update, which Cathie calls Resisting Recession, Ms. Woods has some incredible predictions for the upcoming months, and her thesis may surprise everyone. It's a rather honest look at the economy from somebody who stands to lose if bad times are truly ahead. Now, her original upload is over 40 minutes long, but in today's summary, we're just going to go over the few points that I find both rational and likely. We know that after the most recent GDP report, the United States is officially in a recession, unless you ask the White House, of course. But outside of this technicality, it seems like the markets are in this weird, confusing spot. On one hand, the official employment numbers look great. Stocks are back to rallying, and many CEOs reported outstanding numbers in the last earnings round. But on the other side of this story, we have dozens of worrisome developments. Geopolitically, the world is a bit unstable right now. A large disruption in the oil and natural gas markets has seen various European industries disturbed, and with winter approaching, who knows how it all plays out. In the Far East, a massive real estate bubble seems to be finally popping, and here in the United States, massive inflation is pushing rates up at a pace not seen since the early 80s. So many unknowns, so much risk, and yet the markets only fell about 20%, and now they're only down about 10%. Everyone is attempting to predict what comes next. Is this a false rally, or are we headed into deeper water? We know that most bear markets, especially the severe ones, have rallies following the initial plunge that trick investors into thinking everything is fine and on its way back up. Most notably in the 1929 crash. When you read about the crash, you know that the Dow Jones dropped close to 90% from its peak in September of 1929. It would take over 25 years for the markets to recover to pre-crash prices. But what is often overlooked is that following the initial fall, the Dow Jones Industrial Average went on to rebound 48% from mid-November through mid-April of 1930. Nobody at the time was aware that it was the start of the worst economic disaster in American history because of this sucker rally. From there, the Dow Jones declined 80% by the time the bear market hit bottom in 1932. Now, as today's market bounces back up, everyone is afraid of this scenario, and if you listen to Cathie Wood, she's signaling that we're not done with the pain yet. She outlines three main points supporting this notion. The first is consumers, which make up the majority of the economy. If you remember earlier this year, Cathie made it a big point that retailers had a massive influx of inventory that they couldn't get rid of without crazy sales, and now, months later, it seems that this problem continues, indicating that consumers aren't spending nor looking to spend despite deep discounts. Take a listen to her explain, but before you do, please take a moment to hit that like and subscribe button if you're enjoying the content thus far. Now back to the clip.
The other reason I think we're in a recession, and we've talked about this, we won't go into it too much, but the inventory buildup that Walmart and Target and Home Depot, Costco, all of them were describing in their April quarters. They do not seem to have gotten them under control if the macro indicators are any indication. We've got on both the wholesale and the retail level, month-to-month increases in the 1.5% to 2% range. Now, if GDP is revised up, and it could even be revised into positive territory because of inventories, that won't take us off of this recession, this thought that we're in a recession, because inventories are piling up because consumers are shutting down.
So now with retailers overflowing with inventory and Michigan's consumer sentiment survey at an all-time low, lower than what it was in 2008, you have to wonder what's really going on out there. Her second point adds to this. We know as far as recession indicators go, one of the most accurate is the yield curve. I've explained this a few times in past videos, but essentially when the curve inverts or when this point goes below this line, you can almost always expect a recession in the coming months. And as you can see in recent weeks, this inversion is becoming severe, giving us a very obvious warning that's hard to push away. Take a listen to just how bearish Cathie has become following this development in the bond markets.
The interest rates are down almost 70 basis points to 2.83%. Meanwhile, short-term interest rates, 2-year Treasury yields, they have moved up in lockstep. They're at 3.24. So now we have an inverted yield curve to the tune of 41 basis points. It's just getting more and more inverted. And that's basically the fixed income markets telling the Fed, okay, something's going to give here. It's going to be the economy, which is caving in many ways, or inflation, or both. And we think the answer is both. And we also think, and I'll get into this in a moment, that the surprises are going to be quite significant on the downside when it comes to inflation.
Now, the last point Cathie makes is the stagnation of the housing market. As you may already know, housing makes up around 15 to 18% of GDP, and with reports of slowing sales and price drops, there is concern that this slowdown could add even more pressure to an already poor situation. For example, she points out that Robert Shiller, the man who quite literally helped create one of the most used housing indicators, the infamous CaseShiller index, that man is predicting that home prices will drop 10%. He recently went on Yahoo News to discuss this point, pointing out the fact that the futures market is indicating a drop much worse than the commonly accepted opinion of experts.
It's not necessarily a bullish indicator. It looks like we were misplacing our judgment because of that. I like to look at the futures market, which most people don't because it's not a very liquid market. But the Chicago Mercantile Exchange has a futures market in home price index, the CaseShiller Standard & Poor Home Price Index. And that's in backwardation now. Prices are expected to fall by something a little over 10% by 2024 or 2025. That's a good estimate. That's the market at the moment.
And with all of that trouble, it's no wonder why many are beginning to think that this is a sucker's rally, yet another head fake by the market before the real pain begins. Who to believe is difficult to decide, as so many competing data sources are indicating both bearish and bullish directions. On top of this, quick developments in Europe or our Fed can easily change the course of this market with one misplaced bomb or misspoken word. The risk has been elevated, and thus far it's brought a temporary end to a 13-year record-breaking bull market. Where it goes from here, nobody knows, but according to Cathie Wood, we should at least be skeptical of this recent rally. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed the content.